Depreciation was supposed to be your best friend, so why does it feel like it's about to stab you in the back the moment you try to sell? Every year you claim that deduction, you were essentially borrowing from the IRS, and now at closing, they're showing up to collect. Here's the hidden mechanic most investors never fully grasp until it's too late. The government lets you deduct the theoretical wear and tear on your building over 27.5 years for residential, or 39 years for commercial, but they never actually believed your property was falling apart. When you sell above your adjusted basis, the IRS recaptures those deductions at a rate of up to 25%, which is a completely separate tax from your standard capital gains, and that distinction alone can blindside even experienced investors. Think of it like a tab at a bar, where the drinks felt free all night, but someone always settles up at the end. Your adjusted basis shrinks with every depreciation deduction you take, which means your taxable gain on sale grows wider, quietly, and invisibly while you were busy celebrating your cash flow. The emotional whiplash here is real, because you spent years feeling like a genius, reducing your taxable income and building paper losses, only to discover the exit door has a toll booth. Experts like Brandon Turner and even mainstream tax advisors will tell you this is one of the most misunderstood and emotionally charged moments in a real estate investor's life cycle. Here's where history gives us a clue, because this exact phenomenon has played out in every real estate cycle since the Tax Reform Act of 1986 restructured passive activity rules. Investors in the 1990s who rode the commercial boom into the 2000s got absolutely blindsided by recapture when they sold during the post.com correction. And the lesson then is the same lesson now. The great irony is that depreciation recapture fits perfectly into the broader, entirely predictable cycle of accumulate, optimize, and then pay the piper, which is why the smartest investors plan for the exit from day one. The investing community has a saying that you should always know your after-tax return, not your before-tax fantasy, and that wisdom is worth tattooing somewhere visible. One of the biggest misconceptions is that you can just avoid recapture by not selling. But here's the uncomfortable truth. Even a gift or inheritance transfer has tax implications, and a badly structured estate plan can push recapture onto your heirs at the worst possible moment. The IRS doesn't forget. They just sometimes let someone else do the crying. Now let's talk strategy, because this is where the real power lives. A 1031 exchange, named after Section 1031 of the Internal Revenue Code, lets you defer both capital gains and depreciation recapture by rolling your proceeds into a like-kind property within strict timelines, essentially kicking the can down the road indefinitely if you're disciplined. Opportunity zone investments are another lever, because if you roll your gains into a qualified Opportunity Zone fund, you can defer, recapture, reduce the taxable amount over time, and potentially exclude future appreciation entirely after a 10-year hold. It's not a loophole, it's a feature. Congress literally built into the tax code to incentivize investment in underserved communities, and it rewards patience the same way compounding rewards the disciplined saver. Installment sales are the underrated middle child of this conversation, because spreading your gain across multiple years through seller financing can push some of that recapture into lower income years, smoothing the tax hit instead of taking one catastrophic lump sum in a single filing year. You're essentially using time as your tax bracket management tool, which is elegant, legal, and wildly underutilized. Cost segregation is the move you should have made before any of this became a problem. Because accelerating depreciation on components like flooring, lighting, and land improvements in the early years creates massive front-loaded deductions. And while that increases your eventual recapture exposure, it also maximizes the present value of your tax savings. The practical lesson is that cost segregation works best when paired with a clear exit strategy from the beginning, not bolted on at the end like a fire extinguisher after the kitchen's already burning. What matters most here is not brilliance or timing, but process, position size, and the discipline to model your after-tax outcome before you ever make an offer on a property. One bad exit can erase years of cash flow gains, not because recapture is unfair, but because the investor never built the tax strategy into the underwriting from day one. At the philosophical level, depreciation recapture is just the universe reminding you that every advantage has a cost And the investors who win long-term are the ones who embrace that trade-off rather than pretend it doesn't exist. You don't have to fear the tax man if you've already planned 3 moves ahead, because being prepared is always more powerful than being surprised. The beautiful part is that there's no wrong outcome if your strategy is sound, because whether you sell, exchange, hold, or pass it on, a well-structured plan gives you options instead of obligations. Rational preparation is always more valuable than emotional reaction, especially when it's your net worth on the line. And if you're ready to build a real estate portfolio with these strategies baked in from the start, whether you need help with investing, contracting work on your properties, or finding the right lenders, check out our links in the description below.